All right, so I welcome you all, and in today's session, I shall be focusing on some of the spreadsheets which can be very useful for you when you are working on your different tasks in the course. One very fundamental spreadsheet which you might be interested to learn is how to build up your portfolio. And you can see that even in the spreadsheet folder, the name of the sheet is portfolio building. Okay, so let's imagine that there is an investor and he has got 50 million. You can see here investment in dollar millions, so 12, 18, 30 plus 50. All right, let's say you have 50 million to begin with, and you want to have a portfolio of 3 stocks. So I have chosen 3 British companies. Okay, you have chosen BP, right? GlaxoSmithKline and Sainsbury. So these are the 3 companies, and you have done some. You can be a value-based investor, you can the growth-based investor, and based on your ideas, you think that I think I should invest 24% of my wealth in British Petroleum, 36% in GlaxoSmithKline, and 40% in Sainsbury. Can I ask you, if you have these 3 stocks, and these are the 3 stocks, how do you categorize yourself as investor? Who are you? What type of investment, when you see these 3 stocks, what type of ideas you get, what kind of risk you can imagine you are facing? See from the systematic point of view, systematic risk, unsystematic risk, and I think all these things we have discussed in the class quite substantially. Yeah. So what I can see here is that if you look at these 3 stocks, BP is an oil, GlaxoSmithKline is a pharmaceutical, and Sainsbury is a retail, is a consumer goods. So I see that my portfolio is pretty diversified. So I'm not taking 2 companies in the same industry. They come from 3 different industries. All right, that shows that my portfolio is reasonably diversified. There could be some risk. The risk is that all these companies are the British origin companies. And nowadays, because we are talking about Brexit, deal and post-deal, and so many things are uncertain in the British economy. So you can see that if somebody now is planning to invest in these 3 companies, and if you are a international global investor, you are facing a huge amount of systematic risk. There's an uncertainty which you may face. Okay, so anyways, to keep it simple, you have 3 stocks and you are having these ratios. But of course, you need to have the market values also. So the index I choose is FTSE 100. This is a market index. Okay, this is the old data, but doesn't matter. That doesn't change the situation. One thing you must learn as a student of finance, that you can do nothing, or you should not do anything with the prices or the values. This is the index value, and these are the stock prices of these 3 companies, daily stock prices. It's not 496.20 pounds. In Britain, the stock prices are expressed in pence, in pennies. You know, the smallest unit. So it's basically 4 pound 0.962 pence, you can say it this way. Okay, and this is like 14 pounds. This is 3 pounds, and so on. Remember, the high value of the stock, the high price of the stock is not a mirror of their success. What matters is the stock return. Return matters, not the price matters. Okay. Now imagine your stock price is 2000 and tomorrow it goes to 2002. The second company, the stock price is 20, but next day it becomes 22. Which company is progressing fast? Which company is making fast money? Huh? The second or the first? The second or the first? My question to you, first or second? Obviously second. The second company is making money at 10%, whereas the one who's having the starting price 2,000, perhaps maybe 0.02, 0.01%. So the stock price is not an indicator of the growing wealth of your stock. It's the stock return which matters. We should look at that. So what we do here, now because BP is here and you can see BP here as well, but the difference is that this is the BP stock price and this is BP's stock return. Right? Make sense? And if I highlight the formula, you can see that this is the current price. Use the brackets very carefully. I think I told you before, use the brackets very, very carefully. If you forget to use the bracket and you do this calculation without bracket, it will be B4 minus 1 because B5 and B5 would cancel out each other. Okay. So what we need to do is put the brackets first. B4 is the current price. B5 is the previous price, the previous one, divide by the previous one, and it means that in one day, from 23rd February to 24th February, BP stock price is up by, if I convert this to percentage, it will be 0.17%. So, because these are the decimals, right? If I convert this to percentage, it basically means that in one day, from 23rd to 24th February, just in one day, the stock price of BP is up by 0.01%. Okay, but if you compare the previous prices, and you can see that sometimes you're losing, sometimes you're gaining, and so on and so forth. All right. So this is the way we deal with it. Okay. And very, very quickly, I want to tell you how to calculate, because you don't have to do for every cell. Okay. It's not a matter of that which I should discuss in financial management. It's a matter of Excel tricks. Just in case, if I took this price, if I copy it, let's say I have how many numbers? Well, I have, it's a 2 years data, approximately. So I have how many observations? 502 observations. And that proves my point that on an average, there are 250 working days in a year. All right? Because it's a 2 years data, and you can see that the total number of observations are 502. So approximately 250, a little bit plus minus. So if, for example, I copy this and I have a new spreadsheet here. Okay. I just want to discuss a technique so that you don't have to do the calculation cell. The way I do, there can be many ways to do it. The way I do is that I say equal to, the bracket starts, the current price minus the previous price, divide by the previous price. And once I have this, when I see this plus point, this plus sign, so this goes all the way down. So, or you can drag, but dragging can also take some time. The data is very long. But if you, for example, do this technique, so you do for one, and you have this plus thing, click, it goes down all the way. You don't even have to drag it, okay? Yeah. So the way you can calculate the BP stock return, You can also calculate the GlaxoSmithKline stock return. So you can see here this time, the Glaxo return is equal to the Glaxo's current price minus Glaxo's previous price, brackets close, and then the Glaxo's previous price. And then if you drag down here, for example, not drag down, but just do this, so this goes all the way down. And then you have Sainsbury, same thing. Same way, you go to the FTSE return, and I hope you remember that FTSE is the market value, FTSE value, 100. And here we calculate the FTSE return. So you can see here, the way you calculate the individual company's stock return, in the same manner, you are calculating the index return from the index value. And then this is a little bit, you have to be careful. What I do here is that I have a portfolio, and the portfolio includes 3 companies. Remember 3 companies? BP, who else? GlaxoSmithKline and Sainsbury. And you can see here that B$2, if you don't know what is B$2, I can show you. B$2 is the 24% wealth which you invest in BP. And this will remain same, yeah? Because we agreed in the beginning that I would keep, or the investor would keep, 24% wealth in BP. And then you multiply with F4. What is F4? F4 is the BP's stock return on 24th of February, plus C$2. I fix the value because C is GlaxoSmithKline, and you have agreed, you have planned to invest 36% of your wealth in GlaxoSmithKline, and when you put a dollar sign, that value will remain same, constant. So the reason I put the dollar sign here is that the value remains same, because if you don't put the dollar sign, then the next time it will not be C2, C3, and that will ruin your calculations. So when you put the sign dollar, I hope you know that you can fix the value, you can keep the value constant. And then the same thing, D$4 multiply with H4, which is Sainsbury return, and there you go. Look here. Here, the ratio is constant, B$2, C$2, D$2, and even here, the next day, it still remains C$2, B$2, D$2, doesn't change. The only thing changing is the daily return. The weight, the percentage you invest remains constant, okay? So it's very important that you must fix the values. So this is the average daily return. So you can see that on 24th February, you are gaining on BP, you're losing on GlaxoSmithKline, you are gaining on Sainsbury, but on that day, the market is losing, okay? But if you calculate your average return of the portfolio, it comes out to be positive because it's a weighted average. You know the weighted average? The weighted average is that the daily return of each of the 3 stocks is getting multiplied by the proportion, the percentage you invest in those 3 stocks. I hope you understand the concept of weighted average. Yeah, so that's what we do. And again, once you have this number, and if you go there, it will calculate all the way down, right? So this will be your daily stock return, if I can say so. Okay, maybe you are interested in knowing how much you earn on an average, okay? And you can see there that our first number is 4, J4, and the last one is The last one is J501. Okay, so if I type in average, there is average, and I take J4, I can drag it down, but I can also, if I know how many values I have, J501, I don't have to put the bracket, it's fine. This number is too small, so if I go to formatting and change the number to more decimal places, for example, maybe 5. The number is too small. Yeah, so this is the investor on an average is earning, but don't forget that this is the average daily return. This is the average daily return. What investor may be interested in will be to annualize it. Are you with me? This is the average, but not average for the 2 years, the average, but on daily basis. But you are interested not on daily return, you may be interested in the annual rate of return. Okay. So what we do then we can annualized return. Does somebody remember the formula? Was it so that it was average daily return to the power of 250 minus 1? Is it so? Is it so? No. To the power of 250. Or what was that? We can annualize the return very quickly. And the formulation is that we select the number, the average daily return plus 1 to the power of 250 minus 1. And you can see here the arrowhead, which means that it's to the power of. The number is too small, okay? And as I said before, that maybe you chose wrong stocks, maybe the year was not very promising for the investors, or it could be possible that you have taken the wrong weights. You should have shuffled your weights. This number is very small, and if I format it and make it to percentage to 4 decimal places, so you can see that in these 2 years, investor has earned 0.3667%. This is a yearly return for 2-year period. Okay, but this is the relevance of annualizing the return. So you have the step 1. Let's refresh your memory. Step 1, you have the wealth, and you have decided by using some theoretical concept that are you a value-based investor, growth-based investor? Are you risk lover, risk averse, risk neutral? And based on these different parameters, you decide to invest 24%, 36%, and 40% on BP, GlaxoSmithKline, and Sainsbury, respectively. And then you have the market index value. But as I said, the price and value itself do not show if you have made success or not. We need to go deeper and convert the prices to returns. And that's what we did here, and for the index. And then, this is very important, here we find the weighted average. Remember, you are not just investing in BP or in Sainsbury or in GlaxoSmithKline. You have put weight 24%, 36% likewise. So how much you have earned on the portfolio? So as the name says, average daily portfolio return. And your portfolio is comprising of 3 companies. And when you do that, you have this whole series, 500 plus observations. And then once you find the average daily return, this is what we get. But the investors are mostly interested in the annualized return. And then we annualize it, okay? And the formula is here that you have the daily return, the daily average return plus 1 to the power of 250. I use working, the number of days, minus 1. And that comes to be approximately 0.37%. And this is what we do when we calculate the annualized return. I want to give you an example that how you can normally download the data. And I would be giving you the Finnish stock exchange example, okay? If I type in, for example, Nordic OMX. So this is the index we use in Finland for the NASDAQ Nordic OMX values. If you go to shares, and if you go to historical prices, have you seen what I've done? I went to the shares and then the historical prices. And imagine I'm looking for Finnair stock price, or let's say Nokia. Once I see Nokia is in Swedish kroner, but I would take Nokia euro because that would show the Finnish stock exchange. So I take Nokia in euro from, you see here, 18th of March is the today's date, I guess. If I want to have 19th of February, and for the last 9 years, 10 years, I can change, no problem. I can change as long as data I want. That's my wish, okay? So in this case, I'm attempting to get last 10 years data. You can change the dates. And once I have it, I search. Well, I don't need this, but I need the CSV. And here you can see that we have the last 10 years data. You can see the starting date is 18th of March. And the last thing is 19th of February, 2009. And once again, you can see that, what can you see? It's 10 years, yeah? 10 years. And how many observations you have? How many rows you have? How many rows you have? 2536. Divide 2536 by 10. 254 approximately. So that was my point, that on an average, the working days are approximately 250, some plus minus. So that's the reason I use 250 to the power of 250, yeah? So, and this is how you get the data. The same way, the way you pick the company, individual company, the same way you can pick the index also, all right? When you choose the companies from the same stock exchange, you have to download the data of index only once, because all the companies, they are basically from the same stock exchange, right? Very quickly, I would like to share with you that the bid price and the ask price. Does anybody know the difference between bid and ask? The bid price is, okay, can you see something? Compare the difference between bid and ask. Can you find some relationship between the two? Can you compare them? The bid and the ask. Ask is always higher than the bid. You know why? If I have Nokia share today and I want to sell it, the broker wants to buy it. The broker would buy it at this price. And just I sold him or he bought it, I say, Mr. Broker, I want to buy it back. So can you sell it to me? He will charge slightly more money from me. And the difference will be his commission. Do you get my point? Or not? Yes or no? That's a very common, it's a matter of common sense. That if I take a chair to a furniture shop and I say, I want to sell it, the shopkeeper gives me 10 euros. But will he sell at 10 euros to somebody else? Should be more euros or less euros? There we go. The difference is his commission or his margin. So you can see that the price at which the stock exchange or the broker buys from you is lower, and the price at which the broker sells to you is higher. So the difference is the margin, commission, whatever you call it. Today, when the market started, just when the market started around 9 o'clock, this was the price. And at some stage, the price went as high as 5.624. And at some stage, the price went as low as 5.548. Remember, this is 18th of March. 19th March is today. So you can't get the closing price data now. Can you? The market is still working now. It will close around 4:30. All right. So the closing price at which the market stopped working was 5.558. This was the average price. If you say the overall average, the total volume, how many shares were translated, how many shares were transacted. You can see the number is huge. If you want, I can check exactly how many. I have to format it. If I format, make it a number. Yeah, so these many shares were transacted in the stock exchange. Okay, if you want to find how much values they were carrying, well, basically this will be the number of shares multiplied by the stock price. But anyway, we can check it. Once again, I format and make it a number. This was the value. So you can count how much. It was 784. 1, 2, 3, 4, 5, 6. It was 78 million something shares were traded. And this is nothing. This is some kind of number of shares multiplied by, we can check how much was the price. So if I divide this by this, for instance, just out of curiosity, if I divide this by this, yeah, 5.57. So this was the basically 5.57, approximately the same price. So you know that the number of turnover is equal to number of shares traded multiplied by the average price. Okay. What is this then? What do you mean by trades? These are total shares. These are their values. What is this? Yeah. Number of operations, number of contracts. When you go to a shop and you want to buy a chocolate, right? You can buy 1 chocolate or 100 chocolates if you have a party at home. The trade is 1. The trade is 1. Are you with me? So there are, now if you see here, the previous day, there were more trades. Can you see? Less, more, but the value was less. It means that there were more people buying, but they were buying less shares. Here, the number of contracts are few, less people in the queue, but they buy bulk, They buy huge quantity. Trade huge quantity. I shouldn't say buy. Trading means buying and selling both. Does it make sense? So it's very important for you to know what type of these numbers, what is their meaning. So you can see that when you open the quotes for a day, it's a bid price, the rate at which you sell, but the broker buys. Ask means sell, not you sell, but the broker sells. The price at which broker sells to you will always be higher than the price which he or she gives to you. Because the difference should be his profit. Come on, they have a right to earn some margin. Opening price, the high price during the day, the closing, the low price during the day, the price at which market closes is this. On an average, this is the average price. Total number of shares traded, total number of value, and how many contracts, how many transactions, how many vouchers were signed on that day. Okay, how many bills were created. There we are. So if you want me to find out okay, I want to ask you something. Now you have Nokia's closing price. I am interested in calculating the return of Nokia's stock. But the problem is that I have a bid price, ask price, opening price, closing price, high price, low price, average price. Which price should I take? Closing price. Well done. Always take the closing price, because that is the price which we take the market closing. Okay, so if I want to find Nokia return, for example, Nokia return, then I would be using, is it in the, yeah. So what I would do here, bracket, never forget, closing price, the current minus the previous, divide by the previous. There you are. And if I go here and I have this plus sign, I don't have to drag it down, just do it. It goes all the way down. So I have the Nokia stock return for the last 10 years now. All right. And now you can do the same thing. You can find the average daily return. Yeah. And then you can find the average, the annualized average return. Now you know what to do. All right. In the next case, I'll keep this file there. I don't want to delete it. Maybe I would share with you. All right. Then I go back to the index. Okay. After all, I have to compare the Nokia's stock return. So I repeat it now because I go to the indexes, and here in indexes you can see that there are multiple indexes like OMX Nordic 40. This includes the top biggest 40 companies in Nordic region, right? I think I will not take this because I'm focusing on the Finnish index. Okay, and then I look down, I find that there's OMX Helsinki 25. This is the average, or you can say the overall indicator of the average of biggest 25 companies in Helsinki. Okay, I can bet Nokia is one of them. All right, so what we do here, I click here, and once again I go to the historical prices. Yeah, and what I do here, I can have my preference. Once again, I keep last 10 years, yeah? 09. And if I straight away take it to the CSV, okay? I just want to check, I don't want to play on two spreadsheets. I want to see which is the first day and the last day. First day is obviously 18th March 2019, that is yesterday. And the last day is 19th Feb 2009. If this is the case, let's see. No, this is incomplete. I'm sorry. I have to delete it. I think it took only the annual return. Sorry. I search for it first. So I'm searching the data. I hope I can. Oh, yeah, I'm sorry. Yeah, I made a mistake. So this should be 19 and this should be 9, yeah? Look, somebody's awake at least. So at least one student is listening. Yeah, I'm very happy. And then we have the spreadsheet. I'm not worried about the first date. What I'm worried about is the last date. There should be, the data should be common. As long as it's 19th of February, it's fine. Yes, there we are, 19th of February. Now the first date is same, the last date is same, okay? So what I need to do is, I don't need the whole, can somebody tell me why is this average missing? Because it's not relevant for an index, right? So what I do here, listen, what I'm going to do is, you said that to calculate the return, we need the closing price, yeah? Is it what you said? Everything is same. So what I do, I just copy the closing price of the index and take it down to the closing price. Does it make sense? So now we have the Nokia return. We have the closing price. So I would call it NASDAQ value. NASDAQ closing values. I would rather call value than price if it is an index. Okay. Now, the way I calculated Nokia return, I can calculate index return. And once again, the formula is same. Bracket, the current value minus previous value, divide by the previous value. Oh yeah, because there is a, you know the reason? The reason is that we need to get rid of this. Is it a full stop here? Is it a dot here? Can you see it's a dot? Okay, so what we need to do is, even though this thing is not part of the financial management, but I just want to show you or discuss with you that in Finland, we use not decimal, but comma. If you want to say this chocolate cost me €2.35, you never say 2.35 euros, you say 2.35, all right? But here we have a comma, which is at the wrong place, okay? So what I would try to do my best is to remove this extra comma first and put this comma to the right place. But let's go step by step. My first job is to remove this comma, which is coming soon after 4, okay? So what I do here, I select the whole column, and then I go to replace, and I put here comma. I want to remove this comma, but I don't want to replace it with anything, so I leave it blank. And then I say replace all. You can see that this unnecessary comma is removed, but the life is still not easy. We still have to replace this dot with the comma. So once again, we select it, and go to replace, and we want to replace dot. Did I put the right thing? Decimal with the comma. Okay, and replace all. There we go. Now this is the way. Now it looks the way it should look in Finland because the computers are inbuilt. Of course, you can change the setting of the computer, but I don't want to because otherwise it will take everything away from me. So like you have the, now let's try the index return. Use the formula, the current value of the index minus the previous value, divide by the previous value. There we go, now it works. And once again, when you have this plus sign here in the corner, double click. Now this is the index return. So you have the Nokia return and the index return. Okay, are you with me? Yes or no? Come on. All right. One thing I would like to discuss with you before I give you a short break, okay, is the beta. You know the beta coefficient? We discussed. Beta is what? Huh? Beta is the slope, or beta is a measure of systematic risk. Okay, beta is a measure of systematic risk, and if I can bring this close to me so that it gets continue to record. I try my best so that it's visible to you. So if on the y-axis, I take the Nokia return, yeah. Why I'm taking Nokia return on y-axis? Why not on x-axis? Because the mathematical function is y is a function of x, which means y depends on x, not x depends on y. Nokia's return depends upon the market return. Market return doesn't depend upon Nokia's return. Agricultural production depends upon rainfall. Rainfall doesn't depend upon agriculture. Output depends on input. Input doesn't depend upon output. So it's like a matter of how we rationalize this model. So the Nokia return depend upon NASDAQ OMX return. Okay, and this line is beta, slope. Beta shows how much change in the return of Nokia takes place because of the change in return of the market. Delta shows the change. So beta is equal to change in y. This is change in y. And this is delta, means change in x. So beta is change in y divided by change in x. This is called slope. Beta is the slope. And you can find it here. This is change in y, and this is change in x. And once you divide change in y by change in x, it becomes the slope. Okay? And why do we use mathematics here? Why do we use geometry here? Because systematic risk is measured by beta. It shows how much impact Nokia carries because of the market movements. You get my point? Now we can check. Okay. Please keep in mind how many observations we have here. We have 2.5. The last values. So we have the last value is 2534. Well, it doesn't matter because if you have thousands of observation, 1 or 2 days less or more doesn't make any difference. So let's stick with 2534 is our final cutoff line. Yeah, 2534. Guys, remember So what I do here, I call it beta slope is equal to slope. Can you see the y values and x values? What is y and what is x? What is y? What is x? So the y's should be the Nokia return, yeah? Are you with me? Y should be Nokia return. And where is Nokia return, by the way? It starts from M2. It starts from M2. Can you see here? M2. And it goes to M2534. So what I do, M2 colon M2534. And then I separate. And now I take X values. What is X value? Index return, okay? And X value is, by the way, your P2 to P2534. Closing the bracket is optional, doesn't matter. 0.66. Goodness gracious me, this is a discovery. Nokia's beta for the last 10 years is 0.66. 0.66. What does it mean? It means that if the market goes up by 1%, if the market goes up by 1%, Nokia's stock return will go up by 0.66%. And if the market goes down by 1%, Nokia's stock return will go down by 0.66%. So this shows the sensitivity that Nokia carries due to the market movements. Remember, you can't remain in isolation. Nokia is a company, it lives in the market, and the market is Helsinki Stock Exchange. So any impact in the Helsinki Stock Exchange will be reflected on the Nokia's stock return. Okay, so this is Nokia's beta. You got the idea? 0.66. Normally, we have a category that if you are a risk lover investor, you take the beta more than 1. Yeah. And if you are a risk neutral investor, your beta should be between 1 to 0.8, 0.80. And if it is below 0.80, it shows that you are a risk averse investor. So primarily, based on the last 10 years analysis, which we have done together, it shows that Nokia is no longer a risk lovers company. It's meant for risk averse investor. 0.66 beta is not a very big beta for a growth company, for a tech company, and so on and so forth. So this, you can also say that is Nokia really growth company now? Because normally in case of the growth companies, the beta should be very high. But normally the growth companies, when they mature over time, the beta goes down. This is not a surprise to me. The same you can observe in case of Microsoft or for example, Facebook or Apple or Amazon or any other tech company. Slowly, eventually the beta cools down. In the initial years, the beta is very going up, but then it calms down, right? Okay. So I would keep this spreadsheet continuing, and I would be sharing once we're done with the so from now onwards, all the calculations which I shall discuss with you, I'll focus on Nokia, and then I will be sharing this spreadsheet with you. So what we can do now.